And thank you for joining us today for ITI's Insights Live briefing, unpacking the impact of Canada's digital services tax. I'm Jenny Westbrook-Quartz, and I'm the Senior Vice President of Communications at ITI. ITI is the premier trade association for the global tech industry. Our members represent 80 of the world's most innovative companies. Today, ITI Senior Director of Tax and Trade Policy, Megan Funkhauser, will join ITI's Executive Vice President, Sean Murphy, to break down Canada's measure and discuss its implications. This conversation is on the record and will be recorded. Please use the Q&A function to submit questions. Thanks again for joining us today. I'll now hand it over to Megan to get started.
Hi, thanks so much, Jenny, and thanks everyone for joining us. So as Jenny mentioned, what brings us here today is that last week, the Canadian government took official action to enter its digital services tax, or DST, into force. Canada's DST imposes a 3% tax on globally engaged companies deriving revenue from online marketplace services, online advertising services, social media services, and user data from any consumer located in Canada. While the action was made public on July 3rd, 2024, the DST entered into force on June 28th, 2024, and it applies retroactively all the way back to January 1st, 2022. Yes, I said 2022, and the first payment will be due next year by June 30th. What this means is that global companies are now simultaneously paying similar uncoordinated taxes on digital services in many jurisdictions. And these taxes, they come in addition to what companies are already paying in corporate income tax, and they are causing fragmentation in the international tax system by effectively trying to ring-fence the digitalizing economy. To demonstrate the gravity of Canada's actions, I'll break down what a DST is and the impact of those taxes globally. So a DST is a tax imposed on the gross revenue of globally engaged companies that provide certain digital services to consumers in a country. Let's break down each part of that definition. So first, tax imposed on gross revenue, and this is gross revenue rather than net profits. Taxing on gross revenue is impactful for all companies, but particularly so for low margin and loss-making companies, startups, and so on. When a government taxes on gross revenue rather than profit, the tax does not consider the costs a company incurs to make said revenue. The next part, globally engaged companies. DSTs, including the Canadian DST, generally target companies that have a greater engagement globally. And this is because the measures have a global revenue threshold, which is 750 million euros in Canada's case, as well as an in-market revenue threshold, which would be Canadian dollars 20 million. What this means is that Company A may have a big market segment in Canada, but is not subject to the DST because that company is not as engaged in markets outside of Canada. However, Company B may have a smaller segment of the Canadian market, but is subject to the DST because it has greater engagement globally. This means that two companies providing the same services to the same market have different tax treatment because of the level of their presence in other markets. Next, certain digital services. This measure, the Canadian DST, covers revenue from digital advertising, online marketplaces, social media platforms, and user data. These activities have been narrowly selected to largely exclude domestic competitors from scope. For example, the measure bifurcates between digital advertising and more traditional forms of advertising, even though they both consider consumers in their approach to messaging and location. They also are attempting to ring-fence the digital economy, even though the entire economy is digitalizing. Last but not least, these DSTs are based on revenue or activities to consumers in a country. Tax is traditionally based on permanent establishment. This means where a company has operations or employees. However, a DST is imposed on revenues from where a consumer is located. This presents compliance challenges for taxpayers in that it can be very difficult to discern where a consumer is located. You can imagine in a world of VPNs and so on. But it also presents tax policy issues and that taxing on the basis of permanent establishment effectively provides for the coordination of taxation so that income is taxed once. That coordination falls away when a tax is aimed at a consumer's location and based on revenue. So now that we've broken down what a DST is, you can see how the DST approach upends global tax norms, impacts regular consumers of digital services, and creates significant uncertainty for all companies doing business across borders. In recent years, several jurisdictions have adopted DSTs of varying scopes and revenue thresholds, many of which exclusively apply to non-resident companies or disproportionately affect companies that are headquartered in the United States. All of ITI's member companies rely on clear and established tax rules to innovate and grow their operations, and the proliferation of DSTs has jeopardized that stability. At the same time, ITI members recognize the tax challenges that have arisen from the digitalization of the global economy. ITI and our members have strongly supported and engaged in addressing these tax challenges through the OECD G20 Inclusive Frameworks efforts to foster an international tax system that meets the 21st century economy and provides for stability, certainty, and predictability in that international tax system. Canada's DST comes at a time when more than 140 jurisdictions are working to finalize the years-long negotiations at the OECD G20 Inclusive Framework. Canada's action complicates those negotiations given the 11th hour of the action, as well as that one of the driving objectives for these international tax talks is to provide for the removal of DSTs and relevant and similar unilateral tax measures. This measure also conflicts with both the letter and the spirit of Canada's commitments through the United States-Mexico-Canada Agreement, also known as the USMCA, which provides for non-discriminatory treatment for parties. So all this to say is that this is a truly significant moment in US-Canada relations and the global tax policy debate. ITI, for our part, we are closely watching the actions of the Biden administration and the US Congress, as well as the OECD G20 Inclusive Framework. With that overview, I'm going to hand it over to Sean so that we can dig into these topics a little deeper. Sean, over to you.
Thanks very much, Megan. That was a very helpful overview. There's a lot to unpack, so let's get into it. You said that USMCA commitments are probably violated here. Give us a little bit more and tell us what the United States government can or should do in response to these trade violations.
Mm-hmm. That's a great question. And particularly now that the DST has entered into force as of June 28th, it really begs the question kind of what are the options before the US? And the US has several options. One avenue would be to open a Section 301 investigation so that USTR can thoroughly analyze the Canada DST, seek a negotiated settlement with the Canadian government, and absent a settlement of some kind, is consider actions to remedy a foreign trade practice. Notably, a Section 301 investigation would enable USTR to examine the Canada DST against several standards, including a denial of US rights under any US trade agreement by a foreign country. So in this case, that would be under the USMCA. Or if the action is unjustifiable, unreasonable, or is discriminatory in a way that burdens or restricts US commerce. This is the path that the US government chose to take with some other jurisdictions that adopted DSTs, such as France, India, and the United Kingdom. The USMCA itself also provides an option for dispute settlement through consultations. I should note that as we're talking about what the US should do with regard to DSTs, it's also incredibly important to note that simultaneously, the US government is trying to reach a multilateral tax agreement in the OECD G20 Inclusive Framework that would provide for the removal of DSTs and other destabilizing tax measures in exchange for establishing new taxing rights for market jurisdictions.
Thank you for that. So what makes the Canada DST particularly problematic? Are there particular elements that you want to highlight?
Yeah, so in many ways, the Canada DST resembles what I call the first generation of DSTs, like those that we saw in France and so on. But two factors really make the Canada DST stand out, and that would be the timing of the adoption and implementation of the DST, as well as the retroactivity that is in the DST. So on the timeline, like I said, the DST entered into force on June 28th, 2024. This date is notable for two reasons. The first of which is the status of the Pillar 1 negotiations. Pillar 1 is what I was referring to when governments in the OECD G20 Inclusive Framework are working together to develop a multilateral consensus-based outcome to provide for the withdrawal of DSTs as well as establish new taxing rights, certain new taxing rights for market jurisdictions. As of December 2023, so the end of last year, the co-chairs of the Inclusive Framework expressed their intent to release text for a multilateral agreement by the end of March 2024, with a view towards holding a signing ceremony by the end of June 2024. As negotiations have continued on these technically and politically sensitive and complicated topics, and notably, to be clear, issues have continued to be addressed, negotiators aimed for releasing text for this multilateral convention by the end of June. Now, June 30th has passed, but we understand the negotiations are ongoing and intense, and importantly, governments are still at the table. However, Canada chose to issue the order to enter the DST into force on June 28th, so 2 days before that June 30th timeline. And then the order was then made public on July 3rd. I also want to touch on the point of retroactivity, because retroactivity has come up in other DSTs, notably the French DST and the UK DST. And it's been clear in companies' practical experience that these created very big compliance burdens, as well as the issue of having to come up with paying a tax when you didn't know that was going to be the rule of the road when you were participating in the market at that time. But both of those were in the same calendar year, financial year. As the USTR found in the Section 301 Invest report into France's DST, the retroactive application is unusual and inconsistent with prevailing tax principles. At the end of the day, you want to make sure companies know the rules when it comes to tax policy and jurisdiction. Now, what happens in the Canadian legislation, though, is that it provides for the retroactive application of the DST all the way back to January 1st, 2022. And this retroactivity, it requires in-scope companies to design and establish new compliance systems, begin tracking transactions, and set aside potential payments going back to that January 1st, 2022, even though this measure didn't come into force until June 2024. And there's also challenges for companies reporting pursuant to the US and international financial reporting obligations. What is worth noting, though, is that while the retroactivity in the current implementation of the Canadian DST is very difficult for companies, and it is worth noting that the DST legislation, though, provides the Canadian government with the ability to change the rate of tax for the retroactive application through regulation. So in the interim, ITI and others are echoing this ask to remove the retroactive application of the DST back to January 1st, 2022, because this retroactive application undermines the principle of tax certainty and exacerbates the already significant compliance burden posed by an unusual extraterritorial tax on revenue.
Thanks for that. You made it a lot clearer why companies are burdened by this, but let's talk about other stakeholders. Maybe you can talk about the implications for Canadian consumers.
Definitely. And it's important to note that while the DST is incredibly impactful for companies, both in scope as well as others, it will also have likely have direct effects on consumers, both as individuals and as companies that make use of the services that in-scope companies are providing. Like I mentioned, the DST is a gross revenue-based tax. And that means that some companies in some markets may pass the burden of the tax onto consumers in the form of higher prices. Now, if the company is not in a position to pass on the tax, then the company could suffer serious financial distress because a gross revenue tax is the equivalent of a much higher effective tax rate on income. Or the company could be left with no choice but to exit the market or not to enter the market in the first place. And all of these outcomes are going to come at the detriment of consumer choice. And remember, again, because this is a gross revenue-based tax, the DST calculations only take into account the revenue raised and not the cost the company incurred to provide the services. This includes, inputs, salaries, R&D, compliance, etc. This is also not accounting for the corporate income taxes that a company is paying on its operations, leading to double or multiple taxation. And while we're talking about consumers in the Canadian market, I think it's also important to flag the potential knock-on effect for Canadian exporters, whether current or future. So while the Canada DST falls neatly into what I consider to be the first generation of DSTs, there have been subsequent DSTs and similar measures that impose a gross revenue tax on all non-resident companies that provide services to a certain market, through the internet or digitally. There have also been what are called significant economic presence measures, which create a corporate tax liability solely on non-resident companies' interactions with users or consumers in a market. Governments have increasingly been taking these broader approaches to taxing non-resident companies and attempting to ring-fence the digital economy. Some examples include India's equalization levy or Colombia's significant economic presence measure. And there's a real chance that the continued proliferation of these measures will increasingly and directly affect Canadian headquartered companies that are seeking to enter or expand in markets outside of Canada. And so it's something that ITI will be watching closely, but also has encouraged the Canadian policymakers to consider what the precedent might mean for future opportunities for Canadian exporters.
Thanks. So you talked about this proliferation of unilateral measures, such as Canada's DST, and also the backdrop of these really complicated multilateral tax negotiations. Can you talk a little bit more about how does this all fit together? What does Canada's action likely do with respect to the multilateral effort at the OECD and G20?
Definitely. And I should say, Canada's advancement of a DST, it is a challenge for these multilateral negotiations, but it's a challenge that we hope negotiators can overcome in their efforts to secure a multilateral consensus-based approach. The OECD reaffirmed as recently as last week that countries are still at the table, precisely because referring to the jurisdictions, are making progress. Now, as we've already noted, though, other participating jurisdictions are collecting DSTs. So you may be wondering why Canada's DST is different from the other DSTs. Part of it is this point I mentioned earlier about timing. There's the timing with the negotiations on Pillar 1. It's no secret that negotiations have been happening for some time. The coordination of taxation is technically and politically difficult, and the existing rules have been around since the League of Nations. While participating in these negotiations, however, Canada has maintained its interest in adopting a unilateral measure, as most recently demonstrated by, besides the implementation of a DST, but demonstrated earlier by refraining from joining the Inclusive Framework's July 2023 statement. It was along with Belarus, Pakistan, Russia, and Sri Lanka, because that statement included an extension of the standstill on the imposition of newly enacted measures. Second, the fact that Canada chose to adopt a measure that these negotiations are trying to eliminate. And in ITI, we have concern about the proliferation of other measures given this movement in the 11th hour, as well as the risk of perverse incentives for agreeing to and potentially implementing a multilateral outcome. I think once a government starts to collect revenue for a DST, it may be harder to turn off that DST and commit to a new set of rules, even if that multilateral approach provides certainty, stability, and predictability that all companies are looking for in the international tax system.
The point you made about the standstill is interesting. You spoke earlier about the two different dates for Canada's enactment and then its publication, but what does this mean for companies now? You said the tax bill will accrue sometime next year, but tell me a little bit more about how this is impacting companies immediately.
Yes, and it is, and even though the official collection is not until next year, it's immediately affecting companies in a number of ways. First and foremost, I mentioned the retroactivity, and companies are pulling together, designing new compliance systems to reflect the new rules that are now in place with the DST. Not only are they looking back to that January 1st, 2022, they're also simultaneously in this session where they're having to make the new compliance systems moving forward. And so it is both a prospective as well as a retroactive or a retrospective exercise when it comes to building and designing systems. And this takes a lot of work. And when you think anytime you're establishing a new system as a company, it does take a lot of work. It takes a lot of resources. And it's important to keep in mind the opportunity costs that come as a result of those resources that are now going to designing new systems for a new tax, particularly retroactively. Now, while companies are preparing for the Canada DST and for those payments that'll come next year, it's important to keep in mind that companies are already paying DSTs and similar measures in many other jurisdictions, including Australia, France, India, Italy, Kenya, Nigeria, Spain, Turkey, and the United Kingdom. These are where we've seen DSTs proliferate so far. And I mean, my back of the envelope math from publicly available information indicates that companies have already paid billions in DSTs in recent years. And this is particularly impactful because these taxes are imposed on gross revenue, not income, and they are uncoordinated, which means companies are frequently paying double or multiple tax on the same revenue. And this can be double or multiple tax through overlapping DSTs, in addition to what a company may already be paying in corporate income tax, where it has its operations, its employees, et cetera. And again, in addition to that new tax, there is the money associated with designing, building, and maintaining new compliance systems. And so the effects of the DST are alive and well right this moment. And again, companies are devoting resources to to build their compliance systems. And again, important to keep in mind the opportunity costs that come from those burdens.
So you indicated the U.S. government is already engaging directly with governments that are adopting DSTs. And you spoke about already having concluded some findings that DSTs are problematic, discriminatory. What's the history specifically between U.S. engagement with Canada leading up to Canada's decision to adopt the DST?
Yeah, so the U.S. has been actively involved with the proliferation of DSTs over the years. I mean, there has been clear bipartisan, bicameral opposition to the proliferation of DSTs in Congress, as well as across the Trump administration and the Biden administration. And the reason you've seen this leadership is really twofold. I mean, one is that these measures are disproportionately affecting U.S. companies, but it's also creating fragmentation in the international tax system that is bringing significant uncertainty and unpredictability and so on to these companies that are doing business around the world. And so what the U.S. has done in the past has been to open Section 301 investigations. So the first one was into the French DST, and then several separate investigations were put into DSTs adopted by Austria, India, Italy, Spain, Turkey, and the United Kingdom. The initial Federal Register notices for these investigations focused on the potential for discrimination, the impetus of retroactivity, as well as unreasonable tax policy. Where these investigations led was eventually to what are called the Section 301 transitional arrangements. And in these transitional arrangements, the governments that adopted DSTs continue collecting the DSTs in the interim and commit to withdraw their DSTs in the event of Pillar 1. Simultaneously, the U.S. commits to not imposing any tariff action or terminated the tariff actions related to those Section 301 investigations. And also in the interim, any DST payments that a company makes can be compared against any estimated payments under Pillar 1, so the new tax. The multilateral discussion is going on right now. Any excess between the DST payment and an estimated amount A payment can be used as a credit for future amount A payments. And so that is where the transitional arrangements landed. They expired with those 7 governments on June 30th, 2024. And we'll see where those arrangements are going in the future. But that is where kind of the last, kind of how U.S. engagement formally looked like with the DSTs already put into place. Now, what's notable for Canada is that the Canadian government chose to structure its measure after a measure already found by USTR to discriminate against U.S. companies. And so where the U.S. has gone now the U.S. has been very resolute in its opposition to the advancement of the DST. We really have seen USTR Katherine Tai take a leadership role in her continued opposition to the Canada DST. And at this point, we understand USTR is assessing and is open to using all tools to make meaningful progress. We've been encouraging USTR and the U.S. administration to make clear sooner rather than later its plan for addressing Canada's DST.
So we have two U.S. presidential administrations, two different USTRs seem to have a very common view with respect to these measures. Where's Congress? Is there a role at all for Congress with this proliferation of these measures?
Congress has an incredibly important role to play when it comes to these measures. First of all, Congress has been consistently and bipartisan in its opposition to digital services taxes and other novel approaches. And this public opposition has undoubtedly helped to stem further proliferation of these damaging measures, as have USTR Section 301 investigations. Members of Congress, including key leaders such as Senate Finance Chair Ron Wyden, Senate Finance Ranking Member Mike Crapo, and House and Ways and Means Chairman Jason Smith, have engaged USTR TIE and Secretary Yellen during hearings. They've provided written letters and provided statements. They've also raised concerns with their Canadian partners. And I think it's incredibly important that Congress has made clear their concerns, because absent strong U.S. government engagement, I think there is a risk of a wave of new tax measures that are to the detriment of U.S. commerce and innovation.
Great. We have a question from the audience, which is about California DST and what role it may have in impacting the innovation lifecycle of small or medium-sized enterprises.
Mm-hmm. Yeah, I'm happy to talk a little about that. So we have seen in the United States, several state governments, or a handful of state governments maybe, have moved forward with proposing, or actually in one case in Maryland, implementing digital advertising taxes or digital services taxes. And where the concerns with digital services taxes are very real, kind of regardless of the jurisdiction that implements them. There are some unique considerations for measures that are adopted or considered in the United States. A lot of this comes back to the Constitution, and happy to go through that a little bit more. But I think what's important to keep in mind is that, again, because these measures are on a gross revenue basis, and they're also trying to ring fence the digitalizing economy, there is a real risk of that as companies are subject to DSTs, kind of what does it mean for their ability to devote resources to new ideas and to providing new services? Because many of the DSTs, for example, the Canada DST does have a higher threshold of 750 million euros for global revenue, as well as an in-market revenue of Canadian dollars 20 million. And oh my gosh, I'm so sorry. I think CA was supposed to be Canada, not California. So I started talking about state.
Sorry. Apologies.
That's okay. But to the point though about the innovative life cycle is that when you see DSTs in effect, you see the instability, unpredictability, and so on, and that's going to lead to a less favorable investment environment. Because when companies are looking to make investments, and I guess when I say investments, I'm usually meaning, investments in operations, investments in innovation, investments in jobs. It's really thinking about all the ways in which a company invests in its ecosystem and contributes. That becomes a much harder decision, though, if you have the unpredictability and instability of DSTs, and if, again, being imposed on gross revenue. And I should also put a note for the retroactivity part of it, is that it lends itself to this unpredictability in the international tax system. And so is a company going to be less willing to make a big investment if there could be risk out there of changing tax rules? And so when it comes to the kind of what is the effect on the innovative life cycle for small and mid-sized enterprises, it's looking at what are the ways in which these enterprises are directly impacted by the DST. And a lot of that's going to come from their interactions with other companies, but also their interactions within the ecosystem of, is this a place where companies want to invest and to bolster the ecosystem? For that includes, bigger companies and smaller companies alike.
Great. Well, sorry for messing that one up, and thank you for catching it. And because I bundled the first one, let me just read the next one verbatim. Have you seen any data on the consumer impacts in European markets that have already implemented their own DST?
There are limited studies out there that have looked into it. I mean, I think at this point, I will have to go back and look more closely. So happy to follow up with the person who asked this. But I think what you have seen is that in some cases, some companies have passed on the burden of the tax, and again, in some cases, through the form of higher costs. And so that is one way in which you could see consumer impacts. And again, there's also the impact on consumers that comes from if a company is piling resources into compliance costs, then that comes at an opportunity cost of kind of what is the company not investing in the same way it would in the absence of these uncoordinated tax measures.
Understood. So we talked about the domestic implications in Canada. We talked about the bilateral. We talked about the multilateral. Looking ahead, where does this go? What is the best case scenario to resolve some of these concerns and try to find a more effective way for taxation to happen in Canada?
Definitely. And it's something I always have to remind myself is that it's like, what is this best case scenario? And really long term, the best case scenario is a multilateral consensus-based approach to address the tax challenges arising from the digitalization and the globalization of the economy. And because without a multilateral consensus-based approach, we'll continue to see these standalone measures that are coming to the detriment of companies, of taxpayers, but then also to consumers and the overall ecosystem as that is how you build innovation. And these are uncoordinated tax measures that don't follow kind of sound tax policy principles. At the end of the day, global tax policy challenges require global tax policy solutions. And that's why ITI has been consistently supportive of the negotiations in the OECD G20 inclusive framework. And it's why we encourage governments to focus their efforts on developing a durable multilateral solution to these challenges.
Thank you, Megan, for briefing us and sharing your expertise on this really complicated issue, which we need to continue to watch going forward. And I want to thank you and the audience for your participation. And as a reminder, a recording of this session is going to be made available on ITI's website shortly. Thank you.
Thank you.